What's going to happen in 2024? You came here for the truth, so let me unveil that for you. In today's video, we are going to talk about just that. We are going to look at 2023 overall. I'm going to show you the most important statistics and then show you where there is excess, where there's too much going on, and of course, what will happen with things like gold, with real estate, and everything else interconnected. Once we know this, we can make better decisions for ourselves, for our families. Right now, what we're looking at is some of the most epic runs that we've seen in a very long time, but others are saying, no, 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 this has to change. And that's where we'll begin. You'll see, one analyst or another. In this case here, at present, we estimate that a decline to the 1650 level on the S&P 500, that would be a 65% loss, would be needed to restore historically run-of-the-mill S&P 500 expected returns of 10% annually. So that's the case. The market would have to come down to 1650. Right now, at or near an all-time high. So we need to see a 65% drop in order to get back down to reality. Not even some, epic crash where it's a depression and so on, just to get back to reality. And so we've really come off course. There's no question about that. I don't deny this. But would they even allow this to occur? That's really the difference, because just like in Japan, the markets would be significantly lower if it weren't for the stimulus, if it weren't for the fact that they literally buy the stocks. Japan, they literally buy the bonds. And so they are supporting themselves, but ultimately, in the end, it's just a ghost town. It's a bunch of zombies. Use whatever analogy you want, but that isn't what you would want to see happen where you are. Okay? The people of Japan have decided this is the way they want to go. This is the route they want to take. They've got a demographics problem that will not be resolved, and they will simply slide into oblivion. That's the case. Do you want that for yourself and for where you live? If you're in the United States, would you like to see that? Or would you simply like to witness a change, a big shift that would make things better and stronger and more resilient? Most people, though, they can't deal with the pain that comes along with it. This article here is basically just saying, at best, we have only 8 months before another financial crisis and massive QE when the Fed pivots and cranks up the printing presses again. Could come much sooner, so on and so forth. We get these all the time, okay? There are a number of people that are saying things are way overvalued. As a result, it has to crash. But you need a catalyst. You need somebody to pull the pin on that grenade before it's going to go off, or else it's just going to sit there. Or a stick of dynamite. You got to light it. You got to have a spark before that becomes a problem, or else it's just sitting there. And so this is what people don't understand. Just because there's too much debt, just because there's so much excess, I acknowledge that excess. I acknowledge that it's wild. But just because of that doesn't make it necessarily lead to a crash. That just makes the inevitability of that one whenever we get it much worse. So that's the difference. That's the distinction. Now, this is talking about what we see with the BRICS nations. They are de-dollarizing, okay? So at this time, we have countries around the world doing less and less business with the US dollar. But at this time, by the way, the dollar has been weakening against its peers for a little while here. What we can note is that in most cases, we do find that the US dollar is inversely correlated with the stock market. So if we see a weakening in the US dollar, stock market goes up and vice versa. That's what you need to know. But in relation to its peers, it's weakening right now. Countries are basically saying we want to do less business with the US dollar. It's too strong. If they change their interest rates, suddenly we're at the mercy of it. Everything is priced in US dollars. If our currencies are weak and going to be weak for a while, people don't understand this as well. They don't expect, like China, all these other countries, they don't expect to suddenly be the new US dollar in the next few years. They don't expect that. They're saying, look, if our currency is weak, Why are we going to price our stuff that we're exchanging between each other in a much stronger currency? Why don't we just do business between each other? Do you see the difference there? People, they don't get that. But anyway, that's the way it goes. Gold sits above 2,000 to snap a 2-year losing streak. So at the end of the year, coming through, break past the 2,000. We'll see if it can remain there, but it shows us what's going on with risk. So people go to gold, the average investor that is, go to gold like at the very end. Oh, we got nothing else, let's put it in gold. They really dislike gold. Most investors, the big investment companies, they do not hold gold at all. And so you look at that and think to yourself, maybe that's telling. Maybe that's telling that it's gone past 2,000, knowing that so few have it. Maybe the fact that central banks keep buying it up like crazy. Look at this. The S&P 500, the theme of this year, when we compare that to the global money supply, not in relation to the Federal Reserve's balance sheet, but in the global money supply, it is directly correlated with the stock market. There's no question. Stock market, global money supply. You can measure this in different ways as we do with the money mirror method. Ultimately, one way, shape, or form, you got cash going in somewhere. It eventually makes its way into what is most attractive. And in these recent years, the US stock market, especially the Magnificent Seven, the big tech stocks, those are the ones that have been doing very well, getting a lot of attention, okay? So that's where the money has been flowing into. That's 2023, the story of the year, over 20% gains in that year. You're looking at basically towards the end of the year of 2023 doing extremely well, but overall it had performed good, and the NASDAQ leading the charge there, as you see it on the very top, that green line, the NASDAQ. Tech stocks, people love tech stocks today. Investment companies love tech stocks. 90% of funds, if you didn't see the stat I covered before, 90% of funds hold Microsoft. 90%. Like, it doesn't matter what that is, they're just going to put Microsoft in there. And it looks attractive to them, obviously. It's performed extremely well. But how many funds, if you have a problem, how many funds are going to sell Microsoft? If 10%, okay, well then 80% of funds still hold Microsoft, you see? So now it's got so much dominance inside of these financial funds representing trillions of dollars. You see what's going on here? Okay, this is just showing us the non-profitable tech stocks and the mega cap tech stocks. So those Magnificent Sevens, the big boys, the $1 trillion companies, those they held on to their strength throughout 2023 for the most part. All right, versus the non-profitable tech stocks took a dive. So keep that in mind where we are. When the money is easier, when they're just QE 1, 2, 3, 4, 5, when they're just throwing the cash out there, you want to be invested, at least where you have risk, in these riskier things, because those are the ones that do better. I know that hearing that from me might be confusing, but that's the way it goes. I tell my Finance Friday class, invest in garbage when they start a new round of quantitative easing. I'm telling you, that's what did well the previous time. That's what did well the previous time before that. And it's sad. Now, of course, you got to time that right, because it goes up like crazy and then it starts to even out, and other assets, real ones, start to say, oh, okay, we have some steady ground. Okay, now we can find a place to be. It's one step at a time, okay? This is just showing us the comparison of, world market cap, that's the blue line, direct correlation with the stock market. It's looking at it overall, debt, equity, everything has basically been going up, okay? And what is the correlation there? We can see that the financial conditions eased during that period of time. That's all I wanted to show you. Looking at it for currency sakes, I mean, my goodness, Swiss franc performed very well in relation to the US dollar. On the other end, no man's land, Japanese yen, not even sure why it's still in existence, but I guess traders use it occasionally to diversify out. It's just like holding a stick of dynamite. Just hold. Hopefully nobody lights a match. That's all. Here we go. NASDAQ. Some suggest that the performance is very much like what we saw in the tech bubble. And for good reason, we do see that. I mean, there's so much excess that it's crazy. Crazy. Some call it a clown world, but here we are. Is it the same? Is it a similar circumstance? As we go in, maybe another year of this stuff, another few months of this stuff. Could it be? You tell me. You tell me in the comments. I want to know what you think. Does it have that very similar feel in the year 2000? Interestingly, look at commodities. I brought this up because of commodities. Look at that. Commodities have come down over the last while, the index, and yet everything that you buy has gone up in price during this period. Like, isn't it ridiculous? I just had to point that out. I mean, yes, I do understand, like, oil's not at the highest point anymore. Your gasoline has come down somewhat. I get that. But overall, we take it overall, the stuff that you're buying, it's gone up considerably. And that shows us that the prices never come back down. Keep that in mind. Very important aspect. This is just showing us the odds of a March Fed rate cut. Oh no, that was not going to happen. No way. And then suddenly things changed. And now the vast majority of the bets that are taking place right here are expecting that March is going to be a rate cut. We don't know what's going to happen, but usually the market is actually very accurate, at least the closer we get to that day. Rate cut expectations in 2024, looking at multiple cuts. All that's showing is multiple cuts during the period of 2024, whether that's going to happen March and then maybe skip a month and then, this and that, or it's going to come all the way in the back half of 2024. We don't know, but that would be the number one thing to pay attention to. What's going on with rate cuts? What is the circumstance with recession? Is there a recession? If there is it mild? Is it shallow? Will it be short? That's going to be a big differential, it's going to be a big indicator for what we'll see with rate cuts, how fast they come, what's going to happen with quantitative tightening. Are they going to stop in the middle of the year? Are they going to let that go into the third, fourth quarter? These things are important because that is the number one factor for where the stock market's going to go, where the real estate's going to go. If they start cutting rates, that this is very, very attractive for risk assets. Look at what Bitcoin's going to do. It's going to go wild if they start cutting rates and the economy is doing okay. Obviously we know the truth, but if they think statistically the market is reasonable, okay, we've done our job, we don't want to overshoot, we're going to cut interest rates right now, slowly, that would give the signal for more risk on. Yes, at some point, there's a catalyst. Is it going to be a 63% drop in the stock market? That would be very difficult. That would be some major, major issue. Could that happen one day? Absolutely. But you need a catalyst. You need a spark. You need something to actually take it there, not necessarily just being extremely overvalued and overpriced and ridiculous. You can have drops of 10%, of 20%. That does happen, and it's part of a natural cycle. But at this time, unless we start getting those bank failures taking place and extreme, excess in some way, like we saw a subprime crisis 2020 where they shut the entire world down, we need to see a big event. But understand this, the crazier things get, the bigger that eventual explosion will be. Until then, though, let's party like it's 1999, right? UAE's Abu Dhabi sees non-oil GDP growth of 7.7% in the third quarter of 2023. I'm just showing you here that some economies are growing. Some economies are doing well. In this case here, I wanted to note the fact that a country like this, where, what they were heavily reliant on oil, it's now 50% of the economy. So it's changing. Things are changing. Times are changing. The big shifts are occurring. If you want to be in the classes, the live classes where I talk about all of this stuff, where we look at the money mirror method so we can track this. I've been getting emails every single day about this. What you got to do is click the link in the description, the first link, and you will go to this page, read everything on this page, take you 2 minutes, and then you click the apply button, and that will email me, and then we can simply get that going. But please read that page first. I appreciate that. I want to thank you for being here. As always, hit that thumbs up button. When you do, you are supporting the channel. Guess what? You notify the algorithm like, hey, this is good stuff, and it starts to put it in people's feeds. When you comment as well, engagement really does help the creator out. So I want to thank you for that. Thank you for being here today. And as always, where are you going to be tomorrow? I hope you'll be right here. I'll see you then. Take care.